Hello everyone, welcome back to the channel. Hope you've been well. Today we're going to be discussing the basics of how to build a portfolio. This is the same as how I build my own portfolio. Now it's important to note that these are the principles that we believe in and are the foundation of how a portfolio can be constructed. This is not the end-all and be-all, nor does it cover every single point when it comes to making the portfolio as efficient as possible or looking for the highest growth or any of those things. It's merely a framework, and it covers points on how I believe you should think about constructing your portfolio and afterwards how to manage the portfolio. For example, this doesn't cover anything about tax efficiency, which is actually very important for managing a portfolio long term, but it doesn't, at least in my opinion, it's not a foundational component of what I think about when it comes to constructing a portfolio. So these are some principles and philosophies that we go by in terms of constructing that portfolio that will hopefully serve you in your investing philosophy in the long term. Now, in the future, I will be making a video which also creates a good sample portfolio, and what I call that is basically like a starter set or a starter portfolio, which we believe would be a good fit for anyone to use, and it can be used as a foundation or a base of their portfolio to begin with. So without further ado, let's get started. And I will caution that this video is almost more of a podcast format. There really aren't going to be any graphics or anything, special visually. This is probably something that's going to be more treated like a podcast where you can kind of play it in the background and just listen. So to start off with, number one, I've talked about this before in a previous video, but the first couple steps when we get started should really be started even before money is being brought into the thought process. The first philosophy is make the portfolio reflect your best image of what the future should look like. And note, it's what you believe it should look like. When I show my portfolio every 2 weeks during the update, and we go over some individual stocks or talk about the stocks that we have high conviction in, it's possible that the industries or technologies that we're focusing on aren't technologies or industries that you are interested in. So it's important for you when you're constructing this portfolio to truly believe in the companies that you're holding. After all, if you don't have strong conviction in them, when times get tough in the market and you're seeing lots of volatility, low conviction companies will more often than not get sold on impulse. And in the long term, it's most likely a mistake, as theoretically, before you had purchased it, there would have been a lot of effort and time into researching the company, and chances are it looked good at that time. But because you have low conviction in your belief, then due to a little volatility, your emotions can be swayed and they can sway you towards selling, when in reality, nothing has changed with the company itself, and the best plan of action was to hold long term. Now, having said that, it is totally okay, and it is important to look at the portfolio and make sure that it's constantly representing your vision of what the future should be. As people, we are malleable and we adapt. Our beliefs change and our interests change. And so as you get older and mature, or if you're already middle-aged and you're getting even wiser in your age, you can totally change and adapt the portfolio to how you should see fit. And there's nothing wrong with that. So principle number one, make the portfolio reflect your best image of what the future should look like. Number two, what is the portfolio's purpose or goal? Through this, you can more easily decide the type of investments that you want to populate it with. For example, let's say the portfolio's purpose is a long-term retirement account. Usually what this means is you'll constantly be adding to the portfolio, perhaps every paycheck or every month or maybe once a year. But throughout the lifetime of the portfolio, usually means you'll be adding money in. And furthermore, it's got a very long time horizon usually. So that right there can guide you in terms of how you want to build this portfolio. What you might be able to allocate a chunk of it to higher risk investments. Perhaps these are some high flyers that you think have potential long term because your outlook is 20 years and that company and what they're doing is a reflection of what you believe in, but there's a lot of executional risk. So you're not comfortable risking that much money into it. But because it's a long-term retirement account, you don't mind setting aside maybe 1%, 2%, 5% into something like that. Or conversely, maybe it's a portfolio that you're using to save up for a down payment on a house. And you think, oh, it's going to take me 5 years or 10 years in order to build up this nest egg to put a down payment on a house. And you're not really chasing for growth, right? What you'd be chasing in that circumstance might just be something that's slow and steady. You want to beat what you would get in a savings account, but you also don't want it to be losing money to inflation every year. So in that case, your investment stocks would be different, or even the type of investment itself might be different, right? So the purpose of knowing what this portfolio is doing for you will guide you in the type of investments that you can put in there and the type of stocks that you can pick. Now, one other thing is actually, if you really think about it, the purpose, what it does is it also develops a stronger emotional connection between you and the portfolio. And if you're really into it, even though it might seem comical, you can give it a name, right? After all, there's been countless studies that have shown the simple act of giving an inanimate object a name creates significantly more emotional attachment and a deeper connection. And with that name, your brain will also associate the purpose very quickly. And when it comes to, which we'll get into later on, constantly reviewing your portfolio, maybe every quarter or every half a year, right away your brain will know exactly what it should be looking for. Number 3, give every stock a fair start. This goes into the concept of diversification a little bit. So I believe that in order to have a well-diversified portfolio, it's important to have at a minimum 15 to 20 stocks that make up this particular portfolio. Because at the end of the day, unless we have insider knowledge, all we can see for sure on these companies are what's out in the public domain. And everyone who can see it, who's a retail investor, will see the same things you do. So everyone's on supposedly an even playing ground. Now, obviously with what we've seen in the past, certain hedge funds might have a little more intel on the inside information, or they might have more capital to really manipulate a stock a little bit more. And all those are even more reasons that you want to really diversify your portfolio. So if one of them or two of them or 5 of them aren't great performing, you're going to have others that are doing well and that'll drag your portfolio up. And something that's really important to think about is assuming that you're only buying stocks and you're not shorting. The worst a stock can do is go to zero, right? If you start out with 15 stocks that are the same and you're terrible at picking and somehow 7 of them or 8 of them go to zero, you've lost half your portfolio, right? But the beauty of it is there's no upper limit cap on how high a stock can run. If you look at some of the big names over the last 15, 20 years, and we'll go into this a little bit in point number 4, they can go significantly higher than just 100%. Right? So one stock could theoretically go unlimited. It could go 100x or 1000x. And that one stock could potentially be all your growth in your portfolio. And if you had hindsight 2020, for sure, you'd want to dump it all in. But going back to a little bit before what I was saying, where you only have so much information, if you give every stock a fair start, then you're going to be able to do well when some of those do well, and you'll be able to weather the storm when some of them don't do as well. And these days, even if you're starting with a smaller sum of money, $1,000, $5,000, what have you, the fact that you can do fractional shares means that you can own companies that have a high stock price, like Amazon. Amazon's $3,000. Even if you only wanted to buy $500 of it with fractional shares, now you can do that. Number 4, allocation. How comfortable are you having your eggs in one basket? Now this one might seem odd since we just talked about giving each stock a fair starting line. But if we pull up an example, we talked about a little bit before some of the high flyers, right? So let's bring up Apple. So if we take a look at Apple, let's say you've had this portfolio for 15 years now, or even 10 years now. Back 10 years ago, this stock, accounting for all the stock splits, was $6.86. Or if we go 15 years ago, it was about $2.75, right? And then obviously the further you go back, the lower it was. So if you had 15 stocks that all started at the same place, and let's say Apple was one of them, but since the last 10 or 15 years, Apple has essentially gone up. Well, if you look at $133 now or $131.46, you're looking at a rate of roughly 50x, right? So you would have 50x'd your single position of Apple. It's possible that even though you had originally started with, let's say 20 stocks, so each of them are 5% each in terms of weight, this stock might now be worth 50 or 75% of your portfolio just because of how well it's done. So it's important to decide how comfortable you are with letting one position grow into being a large chunk of the portfolio. Is it 1%, 25, 60, 90%? There's no real right or wrong answer to this, as everyone's number will be different. I found that for mine, when I started doing investing, it was a much larger number because I was willing to risk it a lot more. I didn't understand as much. I wasn't as educated. And funnily enough, perhaps when you have a little more to lose and when you're a little more educated, you start becoming a little more risk averse, right? So when I first started, my number might have been 50 or even 60. I might have just bought 2 stocks and that was the way I started with a portfolio. But now I would say my number, and I would say that it's been this for the last little while, and I expect that this will be the number going forward, at least until maybe I get closer to retirement in 10, 20, 30 years. Right now my number is 30%. So I don't ever let any one company grow past 30% of my portfolio. If that happens during a review, then I will trim it down because I know that that's what I'm comfortable with, and being comfortable with the portfolio, there's nothing quite more important than that, because that way you get to stay focused, stay on the plan that you had set out for yourself, and you're not going to be prone to making emotional decisions instead of logical decisions. And, I was an example right there, but there's nothing wrong with also changing this answer over time, right? When you're starting out and you've got a really long time horizon, maybe your number is going to be really large, right? And as you get older and as you get closer to retirement, you want to be more diversified and you want to be less risky and more risk averse because you want to, your goal is now wealth preservation instead of wealth generation. And so just like your vision, this number can change, and there's nothing wrong with that. At the end, maybe your number is even less than 1. So the only product that makes the most sense now, if you want to still be invested in the market, is something like an index fund, right? So it's really important to know this number. Make sure that deep down you're truly okay with whatever that is and stick to it. And the last one we have here is investment lifetime. And this is kind of a weird way to put it, but basically it's important to keep in mind that there's no expiration date and there's no set date on when you can buy and sell a company, right? A lot of people get caught up in the, buy low, sell high kind of thing, or, they think about dollar cost averaging, and they have this mindset of wanting to keep everything as cheap as possible. And weirdly enough, the stuff that don't do well, or the stocks, the companies that don't do well, sometimes And more often than not, they're not really long-term winners. And they're not really long-term companies and champions that you want to be holding on to, because the fact of the matter is being a first mover has a large advantage, and being a large company has a large advantage, because usually the larger the company, the stronger the moat or competitive advantage that you might have in the market. So if you're a large company in the industry and you've built up a lot of great reputation, a lot of goodwill, a lot of technological advances that other companies can't compete with, especially startups, chances are you're going to continue taking more and more of the market share if the company is continuing to innovate. And part of reviewing a company and your portfolio is to realize that sometimes it's better to put your money where a company is already doing well. So if we take a look at, the 4 or 5 largest companies, absolute largest companies by market cap in the stock market right now. Well, firstly, we have Apple, right? The largest company. You go back to 2000 and you can see you want to focus on companies that are doing well, because when they do well and they're winning and grabbing market share, they seem to continue to do that. So as you can see historically through this trend, Apple just continues to grow and grow and grow until it becomes the largest company in the stock market. And you might say that, that's hindsight bias, or, hindsight is 2020. But the reality is if you pull up most of the major companies, they will have histories of continuing to be innovators and continuing to be winners in their circle. And going back to the point I had before of where the worst you can lose is 100%, but the most you can win is unlimited, you want to be focusing on these companies that are doing really well, right? If we look at Microsoft is a perfect example, actually, of a company that originally did really well, right? And then the dot-com bubble burst, that doesn't really count because that was more of a valuation reset out of technology. But the company was always at the forefront of their industry, right? And they were constantly growing, or at least maintaining market share over time, even in the 2000s when the stock market, or when the stock price didn't do that, much in terms of appreciation. But the company itself was always near the top or at the top of their industry. And this is what I mean. They had a long R&D time horizon and a long time horizon of maintaining status quo. And finally, once innovation started to happen in their industry, they were well positioned to take advantage of it because they had the capital, they had the goodwill, they had the size in order to pour a lot of resources into innovation. And now they've obviously completely grown and are at crazy historic highs compared to previous, right? And this is a perfect example of keeping the mindset that you can always buy throughout the lifetime of the company. Because if you focus on only trying to buy cheap companies and doubling down on your losers, chances are you're going to miss putting money where it will actually maximize your return. And it's a little counterintuitive because you think, the company is already up, let's say 2x from its previous highs, right? If we looked at 2007, 2008, Microsoft was $25, and it was always hovering around this range for the last 5 years or 6 years, back in the 2000s, early 2000s. And finally, it breaks out in 2013, 2014, and it hits, $50, $47, and you start thinking, this company has almost gone 100x since its recent average. Maybe now it's expensive. Maybe I shouldn't add to this, and instead I should double down on a company that wasn't doing well, right? But what happens is you miss you miss the rest of the ride. And by miss, I don't mean, if you sell out, I just mean miss as an opportunity cost, right? The cost of putting your money into a company that wasn't doing well versus a company that is doing well, right? And you can cut off the chart here and you look, oh, wow. Back in 2018, it was at $93. And you also look at the chart and you go, wow, that's really expensive. It's 3 times what it was maybe just a few years ago or 5 years ago. But, the reality is, as companies grow, and especially the ones at the top, they continue to gain market share, right? And that's not true every single time, but it seems to be true the majority of the time. And as long as you're right the majority of the time, it's like baseball. You don't need to bat 100%. If you're batting 30%, 40%, 50%, but the ones that you're really hitting on, you can beat the market and you can do extremely well for yourself. So Amazon is just another one. You take a look at how it was doing. People probably thought it was crazy overpriced back in 2018. It hit $2,000 a share after being around $35 a share for the previous decade, right? That's 100x higher than it was before. But Amazon keeps getting bigger. It just had a recent earnings report, and it reported absolutely crazy blowout earnings, and it gapped up again. So I wouldn't be surprised if these 3 companies continue to lead the way over the next 5 to 10 years, and management and everything at these companies seem to be pointing in the right direction. So there doesn't seem to be anything stopping it in the near future. All right, so those are the 5 philosophies that I wanted to share in terms of how to build a portfolio. First one, the vision. Second, the purpose. Third, give every stock a fair start. 4th, allocation. How much can you handle in one particular company? And 5, you can always invest throughout the company's life. Don't ever think that just because it's gone up, it can't go up anymore. So I hope that helps everyone in terms of thinking about how they want to structure their own portfolio going forward. If you liked it, please leave a like and subscribe. And I will catch you guys next time.